Okay, how you doing, everybody? um, Hang on while I get you promoted. Give me just a second, please. Okay, here's Leonard. Okay, we still got a minute or two. I'm gonna let more folks log in, and I'll promote them as I get you logged in. But good to see you, everyone. Teresa, Michael, Julie, Colley, good to see you. Hey, Julie, I got a message from Daniel Dominguez. He'd actually set up with the one-on-one of the one-on-ones with me. We do student calls every day. So I told him to look out for a call from you. In hindsight, I probably should have given you his information. In fact, I'll do that now. So give me a second and I'll get that over to you. Hopefully things are nice and beautiful and sunny out in Southern California. But let's see here. So Kai, good to see you, buddy. Gina, good to see you. John Perry, good to see you. Kathy, good to see you. Leonard, obviously good to see you. So Leonard, I'm going to go ahead and promote you to co-host. So you should be all set there. Rob, good to see you, buddy. Teresa, Tom Z, good to see you. And let's see, we got a few more here. Hang on one second. Liz, good to see you. All right. Promote, and I'm gonna Betty, good to see you. I'm gonna promote you guys. Heather, good to see you. Good call today. Oops. Kevin Keller, good to see you again, buddy. Hey, Kevin, go ahead and set up a call with me. If you don't have the link, actually, let me grab that for you. Hang on one second. I should have that at my disposal whenever I start one of the classes. So once we get this done, administrative stuff done, we're going to introduce Leonard and we're going to get the boat rocking and rolling. So hang on just a second, guys, while I take care of this. Oops. Strategy, set up strategy. Okay, that should come up any second. Here we go. Okay, so for everyone here, I know you've already got this. Kevin, I know you're relatively new, Kevin, so I'm going to make sure I'll pop this in there for you. Hang on one second. Hosts and panelists. So there's the scheduling link for those that may not have it. We got a few more promotions. Gilbert, good to see you, buddy. Hey, Gil, go ahead and set up a call also so we can keep the momentum going. Michael McGran, good to see you. Same thing, Michael, for any of the new folks. Sam, good to see you as always from beautiful Michigan. Okay, so I'm going to promote other folks as they come on board, but welcome aboard, everybody. Good to see you. We got a great guest tonight, Leonard Cabral, all the way from Hawaii. And as you know, one of our team goals is we'll have a meeting or a conference out there somewhere. And Leonard's going to buy all the drinks for everybody. Yay! In any case, I know Lisa Sears, by the way, we have some folks in Vegas this week at the conference. So I was not there, but so we probably will miss them tonight. And one of them is Lisa Sears, who wants to start to do some business out in Hawaii. She's from there originally and lives in Oregon, so she'll be going back and forth. So Leonard, she'll definitely want to follow up with you. She'll probably watch the recording. But guys, I tell you what, let's go ahead and get started here. So just real briefly, Leonard is the third of three guests to talk to us about life insurance. The first person was going back to the old school, traditional, straight whole life and no bells, no whistles, things like that. The second group, that was October 1st. And then we had Cameron and Anthony on, or Tony, mid-October, a little bit more advanced. The industry's evolved. They talked about universal life. Well, Leonard's going to talk a lot about the more of the latest evolutions, index universal life, with some other benefits like a conduit account. So you guys ready to go and get started? All right. And Leonard, welcome aboard. I appreciate you taking your time to do this, man. I know you're busy, and it's, I guess, just after lunch out there, and in the land of big waves and palm trees and coconuts and pineapples. So I'm glad you're doing this. Thanks, Leonard, for coming on board.
Hey, Gary, I'm not in Hawaii right now. I'm actually in Seattle, Washington. I just landed like 2 hours ago. So
all right.
Literally was just putting the final touches on the presentation. But hey, thank you for inviting me to this awesome call. And so, yeah, let me share my screen real quick.
Okay. And while Leonard's doing that, guys, just to give you a quick little bit of intel. So Jonathan Perry is on our team. He's on tonight. And Jonathan introduced me to Leonard and some other cool people, Andre and Rick, Hermes, some other folks that are doing this index universal life and helping other investors invest in real estate. And Leonard is actually coming to Pittsburgh on the 18th of November this month to do a live event with me. It's actually three full days. I'll be there. I mean, my role is going to be limited there. So it's really more about what Leonard and Rick and Andre and John have to share with you, which I started seeing last summer, and I'm doing myself. So I think once you see this, you'll see why. So Leonard, thanks for letting me get that little extra piece of intel in there for you.
No, awesome. Yeah, so I'm literally flying home on Wednesday, and then next week flying out to Pittsburgh. So I'm going to be spending more time on this side of the water than in Hawaii this month. So it's kind of crazy. Real quick, I want to keep this presentation short so we can have more Q&A on the back end. I think for the most part, you guys understand a lot of it. I'm just going to give you folks the high level information to give you an insight into what we can do. And so I've been doing this for about 13 years now. Actually, in a couple of months, it will be 14 years. And I never wanted to be your typical life insurance guy that said, hey, Gary, how much death benefit do you want? And so I've always looked for ways to use insurance as a tool to create wealth. And so this is just one of the many strategies that we offer and we teach people. And this one is specific to real estate investors. And so to give you a little bit of the backstory, the way this particular strategy was created was more for people that don't have a retirement plan, because again, everything that I drive for is for tax-free retirement income. And the reason why I drive for tax-free retirement income is I truly believe that taxes are going to go up in the next 10, 15, 20 years. At least that's what I used to say. Now I tell people taxes are already going up. And so if you don't already have a plan in place, well, you're already slightly behind the 8 ball. And so this strategy allows people to pay their bills simply by paying your bills to create your tax-free income. And so I'm going to show you folks how you can do that, as well as at the same time being able to invest in real estate and fix and flips and whatever you want to do. There's going to be a bucket of cash on the side. And so understand that all these strategies are all customized to you, right? There's no cookie cutter here. I actually have to take your information and take your goals and your ideals and what you want to accomplish. When do you need access to money? How much money do you need access to? All that stuff, and then come up with a plan that is designed specifically for you. So when you're looking at these numbers that I'm going to be showing you, don't get caught up on the numbers because the numbers will change based on your information, right? My whole goal tonight is just to show you the concept of how the money flows and how you have access to your money, right? And so again, just to reiterate real quick, this strategy was designed initially for people to just pay their bills and create a tax-free retirement income. But I've modified it somewhat to also accommodate for real estate investors. So here we go. So here's my quick disclaimer. I'm not here to give you any type of tax, legal, or accounting advice. If you need that, you need to go see a tax professional or some kind of professional to get that advice. This is just for educational purposes. This is what we're going to be talking about, flow of money. I'm not going to be talking about too much of that or too much about the smart banking strategy. I just have a few slides, and then I'm going to go right into the actual case scenarios. And so here's the first scenario that we're going to talk about when we go into the illustrations. I'm going to use a 30-year-old male. We're going to create positive arbitrage. Actually, it's net zero out-of-pocket cash, right? Net zero cost. And so, and for this gentleman, we're going to create a $200,000 tax-free income. And then in scenario 2, we're going to use a 60-year-old male, create positive arbitrage, net cost zero, create a $30,000 tax-free income, while having access to cash to do his flips, but more importantly, create an asset protection for what he already has. Okay, so there's 4 pillars when you're looking at any type of financial scenario. There's 4 different pieces to this puzzle. The first one is cash creation, which is it's a no-brainer. It's how do you make your money, right? Whether it's through real estate, whether it's through your 1099, whether it's through your company, whether it's through your W-2, whatever it is, right? However you earn your income, that's your cash creation. Cash capture. This is where I want to spend a little time because this is where you have to understand. For most people, especially real estate investors, where do we put our money? We put it inside of a bank. And what do we get when we put it inside of a bank? And by the way, I forgot to say, Gary, if anyone wants to come on and ask questions, or by all means, just unmute yourself. I can't see anything else. I can't see people raising their hands or anything. But if someone has a question, if you could help me out and let me know, and
Absolutely,
we
yep.
can stop.
You've got a pretty lively crowd here. Once we get rolling, it's usually pretty engaging, and you'll see. And by the way, everybody watching, bear in mind, watch this and learn from the perspective of you and how you can benefit from this personally, but also for the benefit of your clients. Okay, all those investors out there. This isn't. This has been going on for years. It's just a lot more evolved now. The product's way better than it was when I started back in the 80s. So and it's growing fast. I mean, it's probably one of the fastest growing business sectors that I've seen. So think about it from both perspectives. Okay. Thanks, Leonard.
Awesome. So yeah, so let me get back to cash capture. Cash capture is just where do you store your money? And for most people, it's storing it inside of a bank, right? And what does a bank give you? They give you a whopping 0.25%. And other than that, most people don't use the other services of the bank. And so if you look at a bank simply as a storage unit, that's it. No different from those storage units you go down the street, right? Store You More, where you put all your excess furniture in and you pay them a monthly fee. This is no different. The only difference is that they're actually charging you more than the furniture down the street, okay? Because a bank is just a storage container for your money. And how do they make money? Well, they buy your money. Well, they call it a deposit, right? It's all wordplay, right? They call it a deposit, but they're actually buying your money for 0.25%, and they're turning around and selling it or loaning it to someone else for 12, 16, 18, 22%. And the difference between what they buy it for and what they sell it for, that's called arbitrage. Well, that's what is how they're charging you your money, because if you understand how to create your own bank, and how to use your money to create arbitrage, and you loan it out, then doesn't it make more sense for you to find a more efficient storage unit, right? And that's all it is. And that's how simply I want you to look at this. All we're doing is switching storage containers. That's it. Instead of using the bank as a storage unit, we're going to find a more efficient storage unit that gives you a better ROI, gives you more access to your cash, gives you more benefits, and it gives you asset protection. Okay, and so that's the whole crux of this whole thing, right? Cash flow, no brainer. The difference between what you earn and what you spend, and then cash control. For me, this is a big one. I want people to have control over their own money. Okay, because no one cares more about your money, just like no one cares more about your children than you, right? And so why are we so quick to give access to our money to someone else? No, let's hold on to that cash and let's make it work for us. Okay, and this is why we're here, and this is why what I love about GIG is that it's about educating you folks. It's about educating your clients about how to become better managers of our own money. Right? And that's all it is. That's all we're trying to do here. So here's a concept. Okay, this is a smarter banking strategy. Right now, when people, the top left is your cash creation, and your bottom right is your expenses, your monthly bills. Now, this is a 30-year-old male in Hawaii. Okay, I just want to preface that because I did this presentation for somebody in Michigan, and they were like, that this guy must be balling. No, in Hawaii, you can be making $4,000 a month as a 30-year-old and still be broke, right? And so this gentleman is making $4,000 per month, 30-year-old, and he has $2,500 a month in monthly expenses. And so every month, what does he do? He pays his bills of, $1,850. Okay. And so he takes his income, pays $1,850, and now he has nothing left over to show for, right? It's gone, it's done, kaput. I'm sorry, it's actually supposed to be, I should have updated that. It's actually supposed to be $2,500 a month. Okay, but he has nothing to show for it at the end of the day. Okay, so watch this. Simply.
Hey, Leonard, hang on just 1 second. Hey, can everybody see Leonard's screen? I can see it, but I just got a comment saying they couldn't see Leonard's screen. So if I can get, so Tom's in, okay.
I can see it.
Yeah. Hey, Gina, try to do a reset or something. I'm not sure why that's happening to you. Well, it's being recorded too, just in case. So, okay. All right. Sorry, Leonard. Go ahead. Yeah.
No problem. No problem. So here we're going to add 2 additional tools into the picture. Okay. And again, it's very flexible. But in this scenario, we're going to add 2 additional tools. One is a personal line of credit, or it could be a HELOC, or it could be a SLOC, or it could be many other lines of credits, right? But so that's what the top right-hand corner represents. And the bottom right-hand corner just represents our private reserve account. And we're going to use this account as, it's a life insurance policy. But understand this. It's a properly structured, properly funded life insurance policy. It is not your typical life insurance policy where you need to die to access all the benefits. Okay, this is a policy that is designed not for the death benefit, not for these living benefits that we also talk about, but this policy is designed for your tax-free income in the future. Okay, and so when it's properly structured and properly funded, it gives you a whole lot more benefits than a typical life insurance policy. But I also want you to look at it just as another tool. Just like if you were a carpenter and you went out to work, well, if you didn't have your hammer, you're useless, right? Well, you need the right tools to create wealth, and that's what this does. Okay. With that being said, I also want to say this is not an investment. Right? This is just your financial foundation. This is what you build upon. Okay. This is not the wealth creator. What you folks do with it, real estate investing, that's the wealth creator. This is just a more efficient way for you to grow your money and protect your money. That's all it is. Okay. So understand that and keep it in the right perspective. And so now with this strategy, what we're going to do is we're going to pre-fund the life insurance policy from the personal line of credit with $20,000. Again, this is in the first year. So the first year is a little different. So we're going to pre-fund the policy, but now we're also going to be using his income to pay down that line of credit and also to pay his bills. Okay, so the first year is a little different. Now in the second year, what happens is we take his $4,000 income, we dump it into the line of credit. And again, this is just using the concept of velocity banking, which I have tools to help people with that as well. Okay. And so we using the concept of velocity banking, you put your cash creation, your income into the line of credit, which brings the equity down. Now that the equity came down, we can dump $3,527 into the life insurance policy. And then from there, what we're going to do is we're going to take $2,500 out of the life insurance policy, put that back into the line of credit, which then we're going to use that $2,500 to pay his bills. So when we just break this down on what just happened, number one, if we had anyone who was making $4,000 a month and had $2,500 in bills, what's the likelihood of him being able to get a policy and being able to put $3,500 a month into it? Zero, right? Because he's net positive cash flow of $1,500 a month. So we literally, by adding these two tools into this picture, we printed $3,527 a month for this guy. Okay. And at the end of the day, he's still paying his bill. So this is where we come up with the net cost zero, because he's still paying his bills. But because we're flowing his money through these two additional tools, this is how we make the strategy work. Okay. Now, if we fast forward, this is the actual life insurance policy. So you can see this is a 30-year mill in Hawaii. This is $1 million policy. And what we're going to do, you can see in the first year, he only put in $29,196, so the $20,000 from the line of credit, plus an additional $9,200 out of his own pocket, right? Starting the second year, he is now putting in $3,527 per month every month. But watch this. If you notice, again, in the first year, he didn't take any money out. That's just the way this strategy works, okay? But starting in his second year, when he puts that $3,500 in, he takes $2,500 out per month. That's $30,000 a year. And he just does that every month. Puts $3,500 in, takes $2,500 out. Puts $3,500 in, takes $2,500 out. Okay. But what I want you to pay attention to is on the far right hand side, and you can actually go further to years 1 through 5, but I just particularly want to look at years 6 through 10. You can see that he actually has access to cash, right? Simply by adding these two, the line of credit and the private reserve account, he now has a savings of just about $70,000, right, in year 6. Now, what this money represents, this is his cash surrender value, or money he has access to borrow still, okay? And so you can take out typically about 80% of that number. So in this case, it's $56,000. So this is where it gets good, because now let's just say someone comes up to you and says, hey, I got this project. I got this deal, 90 days. I can get it done, 12% or 10%. Let's just say it's 10%, and they need $50,000. Well, now you or your client can pull $50,000 out of your life insurance policy, do the deal, 90 days later, get back to $55,000, pay back this loan, okay? And I would even put that extra $5,000 into this policy, because guess what? Let's just say in 90 days from today, that another opportunity comes up. Well, he has access not just to the $50,000, but that additional $5,000 that he put into it, because he basically paid back some of that other loans, right? And so this is how you can then generate cash flow. Now, if you can think about this and expand on this idea, what if you had five clients, and you had people that knew how to, you were the broker between the people that could flip the houses, and you had clients that had these policies, and you could just match these deals all day long. You as the broker, now you're not only are you getting more deals being sold and bought, but now you're also you got clients that can fund those deals, right? So it's truly a win-win situation. And the only person that we're cutting out of this whole equation is the banks, right? The other person that we're cutting out of this equation, her name is Iris. Not sure if you guys know who Iris is, but most of you visit her every April 15th, right? IRS. right? And so those two entities I could care less about, okay? And so understanding that they're the only two people that we're trying to cut out of this deal. And by cutting them out, more money is left in for us, right? For you or your clients. Now, if we fast forward, he's still paying his $35.27 per month, still taking out $2,500 per month. Okay, at age 65, we are done. Okay, and it doesn't have to be 65. We can make it 60. We can make it 70. We can whatever age you want, right? I use 65 because mentally, this is what people think retirement age is about. Okay, so whatever, you know, wherever that dial is for you, that's where we're gonna move it. In this case, it's 65. Okay, at age 66, we are done paying premiums. Not a penny more is going to go into this policy ever. Okay, but starting at age 66, this gentleman is going to draw $200,000 tax-free income every year for the rest of his life. If we fast forward again, he's turning 75, 80, 90. He's still drawing his $200,000 tax-free income. At age 100, 110, 115, he's still drawing his $200,000 tax-free income. At age 100, he has an $800,000 death benefit if he were to pass away at age 100. Not only that, at age 100, he's already collected $7.8 million of tax-free income. Think about it. How much real estate, or what do you need to have in order to create $7.8 million of tax-free income? Tax-free income, 7.8 million. That means he generated the equivalent of about $12 million, right? Because he would have to generate $12 million so that he can net 7.8 million. That's insane, okay? And oh, by the way, he still has a life insurance policy. So when you really think about this, how much money came out of his own pocket to fund this whole strategy? Nothing. All we did was flow his money through other vehicles and literally printed this out for him, okay? Now, just for the fun of it, I like to go to age 120. He's still collecting his money, and now he has a $14 million tax-free death benefit for his beneficiaries. You think you can leave a legacy for the people you leave behind? Definitely, right? So that's a 30-year-old male. I know some of you are going, well, that's fine and dandy for that 30-year-old chump, but what about someone who's slightly older, right? So here's a 60-year-old male, still $1 million policy. So you can see that the premiums are slightly higher, okay? And because we're only funding this for 10 years, that, you know, there's two main factors in these strategies, right? How much money we put into it, and how long we continue to fund it. Okay, so the more money and the longer we fund it, the better the numbers will look. So just keep that in mind. Okay, so in this strategy, we're putting about $8,200 a month into this policy, and we're taking $5,000 a month out of it to pay his bills. Okay, and so again, you're still using the same concept. But what I want to show you is in this scenario, look how much cash value you have access to. This is what you can borrow to do your deals, right? So when you look at this, in year one, you have access to about $65,000. Year two, you have access to about $90,000. Year three, you have access to about $130,000. Okay, so again, this is money that you can borrow to do your deals, right? The only thing I always teach people is the money that we're borrowing in the green column, that money we've already accounted for, and you don't have to pay that money back. The money we're borrowing on the left-hand side, the right-hand side, in the cash surrender column, you need to pay that money back. If you don't pay that money back, this policy will lapse. Okay, so just keep that in mind. And you know, I can show you guys way more complicated things, but I just for simplicity's sake, you know, I just want to whip this up for you. But just like the other scenario, in year 11, we're done paying premiums, but now we're collecting about a $30,000 tax-free income. Yeah, nothing to, write home about, but it's still, this is more going to be supplementing your income. Okay. Continuing on, still collecting $30,000 per year, right? And it just goes to 120, same thing. But at that point, this actually at age 100 in this scenario, the guy has already collected about $1.4 million. Not bad, right? I mean, he put in, basically didn't put really any money out of his own pocket to make this happen, and still was able to generate $1.4 million by age 100. This is the IRIS codes we use, and I show this just because I want you folks to understand that everything here is above water, right? IRC 101A says death benefits are tax-free. 101G says living benefits are accelerated death benefits, therefore tax-free. 7702 says cash accumulation gross tax deferred. IRC 72 says policy loans are personal loans, therefore not taxable. And IRC 1035 says the owner may exchange an existing policy for a new one, tax-free. So with that being said, Gary, I'm done. We can open it up for Q&A.
Okay. So a couple of things, guys. Leonard, if we could go back to the Excel spreadsheet showing the case. There you go. Yeah. So when I first saw this, guy, what I've seen before is everything on the right, where you have to see the column that's second from the right. It says cash surrender value. That's what you can borrow against to make, say, like down payments on investment properties, or your clients can borrow against that to make down payments on investment properties, or if they have enough, like down here, when you get to year 11 and beyond, I mean, you could buy properties outright for cash. Okay. Buy the property, use, say, like the Burr method, remodel it, rent it out, refinance it, replenish your capital, and pay that back. Okay. Pay the cash value back. And by the way, when you pay it back, who are you paying back? We'll have some pop quiz questions here. So
Yourself?
paying yourself back. Yep, exactly.
How long do you have to pay that back? Like when you take out a draw like that? I didn't catch that. How long do you get to pay it back before you're in lapse? Is it the year?
So the nice thing is you determine the terms. So in theory, you don't have to pay any of this money back, but that's why I said the money that, if we're, hold on, let me.
Yeah, if we're building it out to be a retirement fund.
Right, so the money in the green column here, I've already factored that in, and you don't have to pay that money back, okay? Because that's still coming out as a loan. But on the right-hand side, in the cash surrender value, that money, I'm suggesting you pay it back. But you don't have to pay it back. So let's just say, initially it was a 90-day contract, but for some odd reason, because, I mean, not that it ever happens, but sometimes the project might go 30, 60, 90 days longer. Okay, well, that means you're not going to get your money in time. Nope, no big deal. You don't have to pay that back right away. You determine, because this is your money. Okay, it's just the sooner you get it back in there, because so what I didn't tap into, and this is another key component to think about. Typically, these life insurance policies are going to generate around 8% interest. Okay, so even though you borrow this money, the money you borrow. So if you look if we're looking at this illustration, the column to the left of the cash surrender value is accumulated value. Okay, the difference between the two columns, and this is the way I like to explain it. It's just an easier way for people to wrap their head around it. The accumulated value is your savings account, okay? And the cash surrender value is like the insurance company's checking account. And so as you're paying your premiums and your cash is growing, the accumulated value is your savings account. And that's why you see that number continuously growing, right? Even though we're taking out $30,000 per year, that account continues to grow every year. And that account on average is going to earn about 8% per year. Okay, now the cash surrender value, the insurance company's checking account, when you borrow money, it comes out of that account. So your accumulated value account is being collateralized against your loans. Okay. And
Okay.
so you borrow money at 4%. Now the money that you borrowed in let's say you borrowed another $50,000 to do a deal. Well, that $50,000 is still inside your savings account, still earning 8% while you're paying 4% interest. So you're still net gain 4% interest on that 50,000 that you loan somebody else that's going to give you 10%. So this is a way, and this is where the magic happens, that your 50,000 is working in two different places at the same time, because
Okay.
you have it working in the flip and you have it working inside the policy at the same time. But you don't have to pay it back right away. I mean, you want to pay it back. It's just if for some reason you can't pay it back on a scheduled time, well, that's where you have the flexibility.
Okay.
Yeah, and so really, the cool thing about borrowing against the cash surrender value is, number one, you're outside the banking system, so we don't have to follow all of the rules and regulations for banking, because this is in the life insurance industry and has different set of IRS rules and codes and everything. So what happens is, when you borrow money from a conventional bank, commercial bank, what have you, that all gets obviously recorded, reported, everything. Everything is made public. When you do this, it's like private money, except it's your own money. And when you borrow against your own money, you borrow privately, those are generally considered quiet loans. And obviously some private lenders definitely record everything, although they're not reporting the same way you would if you were borrowing from a conventional bank. Here, none of that applies. So you have to, obviously there's rules. You can't borrow, lenders that, I think you can borrow up to no more than 80% of the accumulated value. Is that, I can't remember exactly. I know I've learned this before, but.
Yeah, I mean, depending on the policies, there's sometimes we can go slightly higher, but I typically stay at the 80% rate because just to stay conservative. So everything I'm going to be teaching, especially in this arena, is going to be very conservative. So as you come to me and you say, well, this is what I need, well, then, we'll have that conversation.
Yep. And I'm going to take it a step further, guys, and we'll get back to more questions. If you think back to the summertime, I was talking about us being able to find funds that we could borrow, not necessarily us, but our investors that are outside the banking industry. And what I was referring to was the cash values and life insurance policies. So I've spoken to a couple of people in the industry, Leonard being one of them. Wanted to save Leonard for last, the best for last, right? The reality is let's say, Teresa, you own one of these IUL policies, Index Universal Life, but you really don't want to spend the time to flip homes or buy rentals. It's just you're busy. Maybe you're looking at retirement. You could still participate by loaning that money out. You borrow it out at 4%, but loan it to somebody else for 10%. You see what I'm saying? So now you're making a loan secured by real estate, which is one of the safest loans you can make. And the vision is, and we're working on this now, is to have basically a portal where investors could present their cases. I've got a flip I'm doing, I need X amount of dollars. And the people with life insurance policies have another portal where they can go in and review the projects and choose to fund all or part of any number of projects. And then another portal would be basically like a mortgage broker. Remember, mortgage brokers often are independent. Sometimes they work for a specific institution, but sometimes they're third-party brokers and they're working with multiple institutions. What I'm getting is they can work for us and document the loans. So everything is done correctly according to the law, to the laws in the life insurance business, and also documented, recorded correctly, so that you actually do have some recourse, if somebody does in fact default. But the beautiful thing is we're going to kind of be controlling this thing. So the investors have to be vetted. They're not going to be able to just throw in a project because the website's out there. They have to have an account. In order to have an account, they need to be vetted. We're going to check them out, for everything, criminal background, credit, job history, where they've lived, everything, just like a lender would do. You see what I'm saying? So, and I'm pretty sure we're not going to be the only ones. So we just want to be first. So I've spoken to a number of people in the industry and different companies. And while we don't have every detail worked out, it's looking very promising. So really what I'm trying to do is paint a picture for you to help you see for yourself. You can do this for yourself, and you should. I mean, if you're able to, I'm going to. All right. I may borrow against my own cash value for my own investing, but I may lend it out to other investors also and be part of that portal. And that's just one part of this. I just want to kind of flesh this out, and then we'll move back over to what I call the conduit account, which is on the left-hand side. But while we're on the right-hand side, Teresa, is the picture starting to come more clear?
Yeah, so it makes me wonder then, does it make sense, like if I have a large amount of equity setting in a home, does it make sense right now with the interest rates as low as they are to pull that out and put it into something like this where it's going to, basically it's a net zero interest because I'm gaining an additional 4 whatever percent, right?
So that's a whole different strategy that I implement, Teresa, and yes, because see, right now, if you have equity in your property, technically that's all liability to you, right? If in this society, if somebody wants to sue you, they find out that you have this property that has equity, they have access to it. But if you took the equity out, now there's no attorney in this world that would try to sue you if there's no not enough equity in there. But if you took that cash out of your house and you dumped it into a life insurance policy like this, that is completely liquid to you, you've done yourself 2 things. One, you've protected yourself because now that the house, even if somebody wants to sue you, they're not going to sue you because there's not enough equity. Number 2, you've taken the liquid cash out of your house. So you can make more money. Right now, if you need to go pull that money out, you got to go beg and grovel to get that money out. Where it's already sitting inside of a life insurance policy, you have access to it at any time to make it work for you and make even more money, right? But because it's liquid to you, technically, if you borrowed 300, let's say you took 300 out of your house and you had 300,000 sitting inside this life insurance policy, are you losing anything? No,
you shouldn't be. You should be gaining. Like you said, gaining that not only the protection, but the added interest you're going to earn.
Yes.
And then the ability to have that fluid cash flow, like you said, for further investments and to build upon, right?
Yes.
To build that little pod at the end of the rainbow.
Yep.
So Leonard, would you mind expanding on that for Teresa? So let's say she borrowed, 100,000, for example, from her home, or anybody here that just had even, 50,000, 20,000, whatever. Can you talk a little bit about pre-funding the life insurance policy when you have a like a windfall, for example, like an inheritance or a lottery? Yeah.
So the pre-funding is just to set the policy up, so we can, because the first year we wanna, it's like you're cooking a dish or you're baking a cake. There's some pre-work that needs to go into it. So we are preparing the policy so that in the second year it's going to do exactly what we need it to do, right? So the more we can pre-fund the life insurance policy, so this is where the balancing act comes into play, and this is why most insurance agents don't do this, is because one, you need to get enough money into the policy while not affecting the person's lifestyle, but also get it to a place where the second year we can make it work and be able to have access to all this cash. So the pre-funding is that's another dial, right? Sometimes we're going to put more money into it because we can, and other times we're going to have to dial that all the way down, or we may have to even You know, and this is where, again, another terminology that you'll hear me talk about is buckets, right? Because the bigger the bucket, it allows us to put more money into the bucket, which then allows us to take out more money, okay? The smaller the bucket reduces the amount of money we can put into it, which also reduces the amount of money that comes out, right? So the size of the bucket is probably one of the most important factors we have, which is going to determine how much we're going to have to pre-fund the policy and all that good stuff. So it's all these different moving parts that we do on the back end. So the front end, once we deliver the strategy and the plan to you, it's actually easy to maintain. Okay. It's all the back end stuff too that we got to make sure that we're dialing it in right. And then once we present it, then that's where it's like, okay, yeah, I can make that happen.
Right. Okay.
Yep.
Wow.
I know it's pretty, and guys, we've still got another chunk to flesh out here, but before I go there with the conduit account and how you can use it, it's sort of like using it as a clearing account where you take your paycheck, for example, or any income you have, whether it's commission income, rental income, what have you, you put in this conduit account. That's what I call it, by the way. I know they don't call it that, but that's what I call it. Basically, it's like a line of credit. Could be personal line of credit, home equity line of credit. What you do is you put everything in there, and from there you pay your bills, right? And the remainder you leave to pay your policy, which is really neat because what happens is you get to make your monthly premium payments on the policy, on the life insurance policy. You're still paying your bills. And all the while, you're building this magical additional stream of passive income. Right here where it says $30,000 a year. That's passive income. Okay. I've never seen a life insurance policy have this feature like this. And this is why I was so intrigued. So I wanted to go back and study back when I got started in the 80s with a regular whole life policy, moved forward into universal life. I had one of those too, but nothing has even come close to matching the benefits of this, particularly if you like having passive or residual income. And I definitely do, you know. So in any case, Leonard, if we could get back to that in a moment, what I want to talk about now though is the tax benefits and also the benefits of asset protection. So in other words, life insurance is one of the oldest industries there is. I mean, the big companies, I think the company that the underwriter behind this has been around for 170 some odd years. Is that right?
Yep, 173.
173 years. Yep. That's a long track. That goes back to pre-Civil War. So if you could, Leonard, if you wouldn't mind, kind of flesh out a little bit on what are the tax benefits and what's the protection, asset protection benefits, and then we can go back to the conduit account if that's okay, you know?
Sure, of course. So the tax benefit really is when you think about it, when is the best time to pay your taxes? Because here's what people have to, we're always looking for ways to avoid taxation, but in my brain and what I try to teach people, and again, there's many ways to skin this cat, but Iris is always going to want her piece of the pie, right? And so when I look at it from the entirety of my life. I'm not looking at 1 year or this year or whatever. I'm looking at my entire life. How do I reduce my taxes over the entirety of my life, right? And so when you look at taxes and when is the best time to pay your taxes? Now when it's at its lowest, or in 5, 10, 15, 20 years when we all know taxes are going to go higher, right? And so if we look at it from that point of view, I would rather put my money in right now, pay the tax on the seed, allow my money to grow tax deferred. Technically, it's tax deferred. And the reason why it's tax deferred, because if you go back to the last slide I showed you, code 7702 says your money is growing tax deferred. When that money grows tax deferred, it's because there's two ways to pull your money out of this policy, right? I can call the insurance company and say, hey, you know what? I need a $30,000. I need $30,000. Well, they're going to just send you a check, and now it becomes a distribution. And because it's a distribution, it becomes taxable income, right? But because we're taking it out as a policy loan, which is a second way to do it, when we take it out as a policy loan, because we don't pay taxes on loans, now it becomes tax-free. So, but we always have to err on the side that it could be worse for the client, which is it becomes tax deferred, because if they just call in and request money, they're going to pay taxes, right? But if they follow my coaching, they're going to know, take it out as a policy loan, and now it's all tax free, right? So now you put in money that is already taxed, it grows tax free or tax deferred, and then you pull it out tax free. And that tax free is every year as long as you live, right? But watch this. This is where it gets good. Let's go back to Teresa. So Teresa, you took out this line of credit, which is a loan. Did you pay taxes on that? No. So now you took this tax-free money, you dumped it into a life insurance policy, it grows tax deferred, and you took it out tax-free. Wait a second. I took tax-free money, I put it into a tax-free vehicle, it grew tax deferred, but I didn't pay taxes on it because I took it out tax-free. Oh, wait, and then when I passed away, it pays off the existing line of credit, and my beneficiaries get a huge chunk of cash tax-free. Like I said, there's two people that get cut out of this deal: the bankers and Iris.
Yeah,
Okay?
I like that. Wow.
Yeah, it just gets better. So understand that there's many strategies out there that does that, right? So again, and then to go to the other side of the asset protection, right? It just goes to, if you have any asset that is exposed to litigation, right? And this is very state specific. So I don't want to just blanket out and say all 50 states, because I believe there are some states that this does not pertain to. But in majority of states, once you get once you get this policy in place, after 2 years, no one can sue you for your life insurance policy, not even the IRS. Yep. It is completely protected, right? So that's why if you took the cash out of your house, now your house becomes protected because there's no equity there. And after 2 years of having this policy, your cash inside the policy is also protected. So now it becomes that's how it becomes an asset protection, right? So that's the other reason why I tell people don't wait, because we want to hit that 2-year mark as quickly as possible. And it doesn't matter if people even know that you have this policy that has cash value. It doesn't matter. They can't touch it.
Yep. Yeah, guys, just to give you some context. So when I first got started back in the mid 80s, interest rates were still extremely high, and the Tax Reform Act of 1986 clobbered a lot of loopholes for self-employed people like dentists, chiropractors, doctors, accountants, architects, anybody that had a business was self-employed, like an S-type business, right? They lost a lot of loopholes. So there was a lot going on in those days. I mean, the S&L industry was in shambles, the S&L scandal, right? So what happened is a lot of wealthy people were turning to life insurance, and again, not just for the death benefit. They were buying, they're obviously buying some death benefit for their families and their heirs, but a lot of the business owners. Remember, if you're an S-type self-employed, you own your own business. What happens when a business owner becomes disabled or passes away? What happens to the family? What happens to that stream of income? So while the estate's being settled, and by the way, they often use trust. I'm a big fan of trust. I have a trust myself. So assets are again transferred quietly. Nothing goes through probate. But while all that's occurring, the family receives the death benefit to keep their lifestyle, keep paying the bills, pay for the funeral, all that kind of stuff. And all the while have time to sell the business. Okay. A lot of times businesses lose value rapidly when someone passes away. So in any case, they were doing it for that, but really while they were alive, they would make use of the cash value to borrow against, to invest, to build up the income producing asset base for themselves and their families. And it was all kept quiet. Again, nothing, not illegal. I mean, quiet meaning it wasn't part of a traditional banking industry loan that gets recorded and reported. Okay. So in any case, I just want to let you know this is now available to most people. Really anybody can do this. Whereas before it was sort of for folks who had, were fairly affluent. So in any case, we got a couple of questions, Leonard. So let me get to those real quick, and then we'll move into the conduit account and how that works. This is from Sam. Sam's from Michigan. Do people borrow funds from themselves to build a house? Can you give an example of this type of policy? And then let's see. Basically, we're Kathy saying basically become a hard money lender, but sort of you can. That's correct. And what type of credit score do you need to have a takeout an equity from your home? So let's start with the first question, Leonard. Do people borrow money from themselves to build a house? Is there an example of this? And I would guess the answer would be yes, but normally it would be for investing, I would guess, right?
Yeah, I mean, the nice thing is it's your money, so you can use it for whatever you want, right? And I always my whole philosophy is wherever I can get access to cheap money and loan it out, you know, whether it's hard money or whatever, to make more money. Okay. And so if you can you know, let's say you're doing this strategy, but you have access to another source that might give you cheaper money, I would encourage you to go get the cheaper money and make your money here go work for you. Okay. So it's not that you cannot use this to build your house. You definitely can. But again, I'm looking to create positive arbitrage. So if I can take $100,000 out of here and go earn 10%, I'll go borrow money from somewhere else at $100,000 from somewhere else at 3% and go build my house, right? Because then I'm still net gaining 5%. Not only that, I'm still making 4% inside the policy. And so, so to your question, can it be used? Yes, definitely we can use it to build your house. Would I? If this was the only funds available and I couldn't find cheaper money elsewhere, then I would.
Yeah. And then Sam, to the latter question about your credit score, I haven't been in banking for a lot of years, but I do believe today, if you're in this, if you have a credit score in the 600s, you can borrow money. Okay. 700s, you're obviously much better off. 800s, the bankers are calling you. So, but I would definitely check with your favorite lender. In fact, we're going to have a lender come on here in another month or two. His name's Jim Martin. And Jim and I go back a lot of years. He's, again, an A+ character. I know him personally, and he'll talk to you more about credit scores and all that. But if we could, Leonard, I want to focus on this mechanism whereby we can build this additional stream of passive income for our retirement years, focusing on the first column there. So can we maybe just slow it down and go through, like you have your income coming in, commission income, W-2 income, rental income, wherever it's coming in from, and you put it in a conduit account and you use that to pay your policy, but really pay your bills too. Instead of paying your bills out of your own checking account, you're paying from this account, and the residuals left over, and that helps accumulate this additional income. And I'm probably doing a really horrible job of explaining that, but if you wouldn't mind, slow it down, and I'll look for questions for that, because I know that to me is one of the most intriguing things I've seen.
So that's where this comes into play, right? Because the line of credit, it does a couple things. One, again, it gives us access to cheap money. That's again, you know, because most line of credits is in the range of 1.5 to 3.5%, right? And keep in mind, if you're a business owner, and I'm just throwing this out there in case this pertains to anyone, but there's strategies out there that allow you to borrow your money at, do a strategy where you have access to money at 1.9%, okay, or even less than that in some cases. But so the line of credit is critical for that purpose of cheap money. Number two, it also gives you that flexibility, okay? Because when you're borrowing, let's say you're getting the loan out of the life insurance policy, well, things happen again, right? And you might have requested your money, but then it's a three-day weekend. And so, you know, because the wonderful banks are going to close, well, you might not hit your account in time so that you can pay your bills. Well, if you have a line of credit and you have equity in the line of credit, well, you have that flexibility to continue to pay your bills. And then you don't need the money from the life insurance policy to hit your account by a specific date. So it gives you that flexibility to float that money. But more importantly, because of the way we're using it, right? Because most people, they use line of credits, in my opinion, incorrectly. They use it the way banks want them to use it. Hey, get this money, go buy yourself that nice car, that nice truck, that, go take that wonderful European vacation, because they want you to go and spend the money. But by using this as a tool to pay your bills and to fund your life insurance policy, your private reserve account, now really you're to the money that's going into the life insurance policy is not coming out of your pocket, because we're just using the equity in the line of credit to funnel this whole thing. And then even the money that we're putting into the life insurance policy, we're not taking all of it out. In this case, we're putting $3,500 a month into the policy, and we're taking out $2,500. So there's still $1,000 left over in the life insurance policy. And again, that $1,000 a month, again, compounding interest over a long period of time, that's where the magic happens. So two wonderful things happen right here. Number one, by using the velocity banking, we pay off that line of credit. I can show you folks, I can show anybody on this call today how to pay off your house in 7 to 10 years using the right tools, right? So think about that. If you could just pay off your house within 7 to 10 years, how much stronger would your financial balance sheet look like, right? And number two, because we're having that excess cash build up inside the life insurance policy over a long period of time, that's where the tax-free income comes in. Because remember that $1,000 is growing by every single month, no matter what, right? And on top of that, if we add the third component, which is as you're building up the equity inside your life insurance policy and you're loaning that out and bringing it back in. Well, if you're paying back the loans that you're typically taking out to pay your expenses, well, then at the end of the day, there's going to be more cash value inside of your life insurance policy, which then would generate a larger tax-free income, right? So it's these three things that are flowing that, to the naked eye, we don't necessarily see it, right? But the more you understand this and you start seeing how the money is flowing, then you're going to see how each component actually enhances the next step, right? So you have the line of credit, which gives you the flexibility, gives you access to cheap money, okay? And the second part is the life insurance policy, where you're building up this equity over a long period of time, which then gives you that tax-free retirement income. And it also gives you access to cash to do other stuff.
Go back to the Excel spreadsheet, if you don't mind.
Okay.
Yeah. So, okay, let's look for questions. Just like to me, like you need to have a lump sum to fund that first year after that. Kathy, you definitely, that's one of the, that would be preferable. I mean, not for the life insurance, but for you and I as consumers, not everybody can do that. But the point I wanted to try to make earlier is, this is really unique that you have the ability to pre-fund, and what happens then, you have access to that, to borrow against the cash value much more quickly when you do it that way. So this is a great idea, or exceptional idea, for people who do have a lump sum. Could be a windfall, you sold a property, you sold a business, you inherited somebody, whatever the case is. This could be an excellent strategy because it gives you the ability to accumulate, right? Basically tax-free residual income later on. Gives you the ability to borrow against the cash value to do other things like invest, and still gives you the death benefit, So we got a good question here. What's the minimum amount a person in their 50s should start with? And PF, I'm going to kind of elaborate on that. And Leonard, I know, by the way, guys, I know Leonard has another appointment after this. And for all the Yinzers out there, the Yinzers are people who are from Western Pennsylvania, follow the Steelers. So if you look at what I'm wearing here, see that? That's coming up. They play tonight. That's where I got the term Monday Night Live from. But in any case, so what I recognize or learned from Leonard guys is, we use the example of a 30-year-old and then a 60-year-old. The reality is it's totally customized. I mean, you could be 79 and there's a time frame within which you can pay this off. So can we get to PF's question, Leonard, and kind of elaborate on the, like you can pay it off in 10 years, you can pay it off 15 years, that kind of thing?
Yeah, so you actually nailed it, Gary. It's because it's customized, it's going to be based off of what your needs are, what your goals are, and what we have to work with, right? And so it also goes to, I think, Kathy's question where you said, some people don't have the ability to pre-fund it. No problem, right? My job is to take what you got and then figure out, based on your goals and your needs and all that other stuff. My job is then to figure out how to make it work, right? And I will tell you, there are a few exceptions. Well, I had to come back and say, hey, this isn't possible, right? Because unfortunately, it's not magic. But just know that, if you're 50 years old today, and you said, hey, I would say the minimum, to make it work would be about 10 years. Okay. Anything less than 10 years, it's not going to be, it's not going to have any real results, per se. And so, if you give me at least 10 years, I can do amazing things. Of course, the longer we go. So just keep in mind this concept, right? The more time we have, the less money we need. The less money we have, the more time we need. So if you just look at it from that point of view, then you'll have a better understanding about your personal situation, because there really is no, first of all, there's no right or wrong way, and it's just a matter of how do we take what you got. Because even if I can get you in this scenario right here, right, with this 60-year-old, a $30,000 income is not, it's not great, but if it's just supplementing, let's say you have another $30,000, $40,000 here and another, Social Security of another $15,000, $20,000, well, you're getting about $100,000 income. So again, as a supplement, it still can work, right? And keep in mind that this 30,000 is tax free. Okay, so when I say tax free, it means that once you get your money into this vehicle, the money you're pulling out, you never have to pay taxes again. It doesn't matter who the president is, who's running Congress. None of that matters anymore, because this vehicle allows you the tax-free income, right? And because we're dealing with contract law, it doesn't matter. Once we implement this strategy, they can change the law, 2-3 years down the road, and it doesn't impact you, because you're already grandfathered in, because it's contract law.
Yep. And what's interesting, in all the years I've been voting and watching the politicians on the news, stump and campaign, there's two bodies of law I've never ever heard them ever discuss. One is trust and the other is life insurance. Never touch it, because they all use it.
Yeah.
Everything else. Look at IRAs, guys. They try to tell you they're going to sock it to the rich people, but they're not. Super affluent people don't have IRAs. They have trust and life insurance policies. Middle class have IRAs, and they're going to get sock it to them once again. So now, because of the internet, technology, the evolution of these products, they're available to everybody now. Okay. So just think how you can use this, not just for yourself, obviously for yourselves, but also for your clients. If you work with investors, and most of us do, I can't imagine a single investor that I know that would not take advantage of this. So, and probably because of this additional passive income coming in. So, okay, so Sam, what happens to the house when you take equity out of the house? How does that work? So Sam, when you take what's called a home equity line of credit, you're borrowing against the equity in your own home. So let's say you own a home that's worth $200,000 and you owe $100,000 on it. You have $100,000 equity. most banks will let you borrow up to 80% of the equity, so you can borrow 80,000. There is risk there, and if you default, believe me, they're gonna come after your house. Now technically they're gonna be in second position, right? So they've got to then duke it out with the bank who's got the first position loan, and make sure that loan's current, so that the second loan can take it, the lender can take it to court if they want to. So anyways, there's risk there, but the house doesn't go anywhere. The house is still, as long as you pay it off, in that conduit account, that equity line, if you were to do a home equity line of credit, borrow against your home to pre-fund a life insurance policy, one of those monthly bills would be the payment on your home equity line of credit. If you follow me?
Yeah. So then, Gary, when you do that, basically, you're going to have to look at what your interest rate's going to be for your home equity line of credit versus the interest in the, I guess, the life insurance policy, right? I mean, you got to, it's going to have to be positive.
So let me step back a little bit. Can I interject here?
Yes.
Okay, so number one, if you have a $80,000 line of credit and you have $80,000 in your cash life insurance policy that you can borrow at any time, are you at risk? Let me elaborate a little bit more.
Sam, you were muted.
Unmute, Sam.
Oh, sorry. There is some risk because you had to get a home line of credit.
Okay, wait. Let me rephrase that, Sam. You have an $80,000 line of credit here. You have $80,000 sitting inside your life insurance policy that you can borrow anytime. You can take this money out at any given time and pay this off.
Yeah, that's free money.
Right. So even if you're borrowing at 4% and you're earning 4%, you're not at risk, because at any point in time you can take this 80,000 and pay off this 80,000.
Okay, got it.
That's for one. But number two, I want to take it one step further, right? Because the strategy I would teach you to do is, if your house is worth 200 and you owed 100, I would tell you to go get a line of credit, a HELOC, for 180,000. Okay. And then from that 180,000, pay off your $100,000 mortgage, which still leaves you $80,000 of equity, liquid cash. But your HELOC is no longer in second position; it's now in first position. And because it's in first position, they don't have to fight for anybody. So now they're not gonna look to foreclose on you for any reason, because they're in first position, right? Because the first position is the position we all want to be in. And so because they're in first position, no big deal. But here's the big thing, is when you look at an amortized mortgage versus a simple interest loan, in an amortized mortgage, the interest is already pre-calculated. So they know how much interest you're going to collect over the next 20, 30 years. And the interest in the amortized mortgage is all front loaded. So therefore, all the interest that you're going to pay is all on the front end. Whereas on a simple interest loan, because it's based off your average daily balance, as you're paying down that loan, you're paying less interest. So simply, and this is how I teach people how to pay off your house in 7 to 10 years, simply by getting a HELOC that replaces your mortgage, I can show you how to pay off your house in 7 to 10 years, just simply by using these strategies. So again, if we take it to your question, we replace your mortgage. So now you have a $180,000 mortgage, and we're going to pay it off in 7 to 10 years. But at the same time, you have all this cash sitting over here. Well, how much risk are you in?
You actually are letting the money work for you. You're
Right.
leveraging your equity in your home,
Yes.
and it's working for you instead of it just sitting there collecting dust. Yeah, makes sense.
So we're just stacking. So when a lot of these strategies, I'm stacking one strategy upon another strategy upon another strategy upon another strategy, which then just makes it all I mean, it becomes a wonderful, beautiful thing. You
So
know.
next question is, how do we get an appointment with you?
Gary or John, how did we want to move forward on that?
But I think I definitely want John involved, because John's already involved, guys, and I know John for a lot of years. So I'm doing it myself. This is one of the ones I mean, most of these things, once I learn about it, vet it and check it out, I put it up to the group. This is something I'm actually doing myself personally. But John is, he's local with the team. He's the guy on the team right now. He could be a point of contact. I don't have the credentials yet. I'm working on that. And that's something, by the way, you should maybe look out for yourselves down the road. If you're going to stay in production or in any kind of capacity, communicating with others on a regular basis, serving others, this may be something you want to look into, because it's the structure and EXP Realty with the upline and downline actually comes from the insurance industry. Life insurance is one of the first industries to have that type of structure. And of course, it's accident insurance, home insurance, all that. So in any case, long story short, I would definitely set up an appointment. I know that there's an event that I'm personally going to be at, because it's Pittsburgh where I'm camping out right now, on the 18th, 19th, and 20th. So I'll get to meet again some other guys that are up the ladder, so to speak, and I've gotten to know them too. But John's on the team, guys. John, you want to type in your name and contact information in the chat box so everyone on the team can see it?
Yeah, no problem.
And then Leonard, while he's doing that, there's one more thing we haven't talked about. I know we got to wrap this up here, but one of the benefits of index universal life versus universal life, it has a certain safety feature built in, doesn't it?
Yes. Thank you for bringing that up, for sure.
Yeah.
So understand this. My whole philosophy is I'm very risk adverse. Okay. Warren Buffett has 2 rules on investing. Rule number 1 is never lose money. Rule number 2, go back to rule number 1. Right. So it's about not losing money. It's not about how much money we make. It's about how much money we keep. And so when it comes to the different types of insurance policies, there's whole life, which that's the world I come from. But the problem with whole life is that there's a lot of built-in expenses that are hidden, right? And then you got universal life, where it takes away a lot of those expenses and gives you a lot more flexibility. But the problem with universal life is that if the market crashes, and because your money is directly invested in the stock market, when the market crashes, so does your account, right? And if you just Google universal life, you'll see that there's tons of cases where people lost their entire life savings, right? So I'm not a big fan of that. I don't like to take risk. Okay, I want to be able to sleep at night. I want to be able to make sure that my clients, no matter what happens, they're protected, right? And so it took me a while to fully understand how IULs work, just because I was so brainwashed into thinking that whole life was the best way to do things, right? But when I understood IULs, where we have the chassis of the universal life, the flexibility, the ability to earn more money, I was like, okay, that sounds good. But again, the risk is that if the market crashes, so with an index universal life, what happens is that your money goes into an index account. It doesn't go directly into the stock market. It goes into either the S&P 500 or the Hang Seng or the Credit Suisse index account. And so there's these 2 things. One is called a cap, and one is called a floor, right? And the way it works is when the stock market goes up, let's say there's a great year and it returns 25%. Well, the cap is going to stop you from earning all of that. Okay, and let's just say right now that the cap is at 9%. So even though the stock market goes up 25%, you're only going to earn 9% interest. Okay, and so some people might say, well, that sucks. I mean, I want to be able to participate in the full growth. Well, let me ask you this. When that market crashes, do you also want to participate in that crash? No. So in the floor, what happens is when that market crashes and it passes the 0 point, you're out. You don't lose anything. Okay. And so this is a way that as your money is growing and then the market crashes, it just levels off. And it stays there until the market returns again. Okay. So it's like a ladder where it grows, it levels off, grows, it levels off, it grows, it levels off. Okay. Not like how the stock market goes like this. And so when you understand that, then this is the biggest feature for me, because I never want my clients to be stressed out. Oh, the market's not doing well. What am I going to do? It doesn't matter, because the worst case is you're going to earn 0, right? 0 is your hero. And so this is the reason why I like Index Universal Life, because the cost of insurance is lower. You have the flexibility, but now with an IUL, you have the floor that protects you. And in this scenario, I'm more excited about the floor than how much money I can make, because it's about how much money do we keep, not how much money do we risk.
Yep.
So the 0 is just for the year or just for that time period that it drops.
Right. Yeah.
Yeah, and it doesn't affect what's accumulated. That's just your growth.
Right.
Right.
Yeah.
Okay.
So you never go backwards.
What's interesting, guys, is I spoke to Leonard a couple of times before this, and I knew I was going to have him come teach. But when we look at the demographics of our group, we've got agents, a cluster in like 20s and 30s, and other clusters in like late 50s, early 60s. And I thought, well, let's just do 2 case studies. And we don't have time tonight, but we actually spent an extra time going through the actual calculator. Are you allowed to show the calculator, Leonard, that you showed me the other week, where you can change the age and change the period of time you're paying into the policy to be shorter, longer, and how it affected the spreadsheet here. I don't know if that's something that's allowable or not, but
Yeah, I'm not sure if I can do that tonight.
okay, yeah, that's why I was asking. So guys, as you might imagine, I'm Mr. Nerd here. I want to see everything, and what's really interesting is when I saw that, I realized this is an excellent offering for our clients, because once you know how to do that one-on-one, you can do these things. You have to have the credentials to do it. That's what I'm working on. So that whole thing I discussed earlier about the hub, right? I don't want it to be John and I want it to all of you to participate in that if you want to. It's, again, you don't have to do everything we do on a team, but this is a great way for you to participate in something we're developing to sort of be first in this market, where we're hoping to have access to more cash values for more policies around the industry, not just one company. Okay. And if you have the credentials, you can do that and further serve your clients. That's really the ultimate big picture. Right now, we're building the building blocks, so hey guys, any final questions? I know Leonard, that you've got something else coming up in about 8 minutes, if I'm not mistaken, so we got to really wrap this up. But
Very, very cool. Thank you so much for sharing.
Of course. Thank you.
Hey Jackie, I unmuted you. If you can unmute yourself, Jackie, I think you might have a question. Saw that you had your hand raised. Jackie Z's from right over the river from New York City. Leonard, she's in northern New Jersey.
Well, hopefully I'll get to see you in a couple of weeks.
Okay. I wonder if she's able to unmute herself. Let me go back to the attendee, because I know we got to wrap this up here. I'm going to try to find you, Jackie. Hang on one second. Let's see. Panelist. Jackie Z. I don't see her. She may have logged off. Okay. Yeah, Jackie, you see her? Okay.
She's down at the bottom.
Oh, okay. Jackie Z. Okay, ask to unmute. Okay, Jackie, if you're there and can hear us, you've got the floor for about another minute. So she may have stepped away from her computer, but hey guys, any more questions? Final thoughts, comments, questions?
Yeah, so in order to follow up, we talked to Jonathan first and then get in touch with Leonard.
Yeah,
we
Jonathan
can do
is
a-
with me. Yep.
Yeah, I'll tag team with Jonathan too. You know, we live on equal distance from Pittsburgh. I'm to the west, he's to the east. And real neat guy, you guys all get to meet him sometime because he's on the team and bought a church and made it his home. So a pretty interesting dude and got a lot of investing experience, brokerage experience, and probably one of the best entrepreneurs I have ever met. The guy just, the way his wheels spin, just amazing. So, and he's even got he's so busy, he's wearing a sling. There he is right there. Look at him.
Fantastic.
Took
Right, just
rotator cuff surgery to slow me down, but you know, it's all good. God is good.
Yep.
Yeah, so if you want to text Gary and myself, just hit us up on the text. I put my cell phone number in the chat. So yeah, feel free to reach out and then we'll connect with Leonard. And you know, we'll see each other again soon.
Fantastic. Thank you.
Okay.
Awesome. Thank you so much.
You're welcome. And one more thought, just so your heads up for everybody who wants to run a gig. John and I are putting on the first live gig event in Pittsburgh on the 18th. Leonard's going to be there with some other gentlemen in the PFA group. Andre, Rick, and I think that's it, Andre, Rick, and Leonard. But in any case, we're all going to be there together. They're coming in from Hawaii. So we're going to record that and hopefully telecast it so that after the holidays, hopefully we can do more live gigs, you know, investor clubs using the model. So it's just better in person. But in any case, that's a little side note. We'll keep you posted on that. And John's spearheading that too. So if you get to work with John, consider yourself blessed because he's, you know, again, very entrepreneurial, high energy, and always finds a way to get stuff done. And who doesn't want to work with a person like that? So,
Awesome.
okay, guys.
Brother, appreciate you.
I appreciate you too. And so guys, about 11 minutes ago, the Steelers kicked off. So I'm gonna go support my Steelers. And then I know Leonard, you got an appointment, but thank you very much, Leonard, for doing this, and John for making this happen. Thank you, everybody.
So much, everyone. Great information.
Thank you so much.
Yep, it's good. Thank you.
Soon.
Hey,
Take care.
Everybody,
Aloha.
give Julie Colley a pat on the back. She looks like she's joining the team here. Julie Colley's from Tidewater, Virginia, and now in San Diego. So the latest edition. So,
Welcome, Julie.
Welcome, Julie.
Thank you so much. I
Welcome,
lived in
Julie.
Hawaii for 6 years before that, so I feel very comfortable in this group.
yeah. So we were together in the same office a while back, and back when it didn't have any gray hair, I guess. But it was a fun days. We got a lot more fun to go. Listen, you guys have an awesome night. God bless you and your families, and we'll see you Wednesday night with the team members on the Global Investor Agent Team monthly team call. Lots of good stuff then.
Thank you.
Thank you.
Thanks so much.
Right.
See you
Thank
then.
you. Bye,
Thanks,
everyone.
guys.
Have a good
Good
evening.
night.